economy it's doing too damn well right now. New print from GDP, gross domestic product, has really cooking at a stunning 5.2%, way hotter than most economists and market watchers were predicting, and really kind of flies in the face of, absolutely slowing inflation. But is it this picture of this kind of immaculate soft landing that may be forming, although we still have a couple dark clouds out there on the horizon? But what does this mean for real estate investors, multifamily investors? Well, another piece from RealPage. The census is likely overstating multifamily starts in 2023. There's no doubt that we are building a ton of apartments, but maybe we've overstated it a little bit, and we may not see rent declines in the future as deep as we thought, or occupancy may stabilize even sooner. Then a piece from Collier's Capital Markets Snapshot in the U.S. from Q3 of 2023. Apartment List has the national rent report for November, and Axios, home vacancies near all-time lows as housing shortage bites. You're going to want to stick around for the whole episode. Make sure you're subscribed. Give this video a like. If you're a multifamily investor, active or passive, this is the right spot. YouTube channel and podcast, wherever you listen to those. All right, let's just get into it. Welcome back to The Gray Report, joined as we are every week by Director of Communications and Marketing here at Gray Capital, as well as producer of The Gray Report, Dr. Matt Bosnagel.
Thank you. It's good to be here. I think we were just talking. Beforehand, and I'm kind of skipping your question. You always ask me how things are going.
Yeah, how are things going?
I'm gonna anticipate it.
How's it? What do you see? What do you see?
It looks like, at least in the news here, it looks like there's a little bit of turn, a little bit more room for optimism, whether you're talking about GDP, and we can discuss the complicated mess that is, or really apartments. I think it may be time to think about the potential for rent growth, or the potential that we may be avoiding the worst case scenario. Yeah. There's a lot of things that I've been thinking about this week, and especially in reference to this RealPage article about apartment construction.
Yeah,
and
it's really interesting.
Like, supply is not a runaway thing, and how the market has been adjusting. They were crazy in 2021, and that's what we're seeing now. And now they're not going crazy. They're very quiet because they're reacting to stimulus. They're not, or the lack of stimulus.
I mean, back in 2021, when rent growth was crazy, all of a sudden every developer and investor thought, the rents that I'm going to get 30% more than I thought I could last year.
Yeah.
And so if you were already like developing and you have a project going, then all of a sudden, interest rates go to zero. So the money's free. The growth is better than it's ever been. You're going to try to build as much as possible. And that's what, that's what a lot of developers did. And, it's also what a lot of buyers did. The debt was cheap, and there was a demand for assets from investors. And so the prices, got pretty crazy. And we're working through that, kind of the aftermath of all that right now. But in terms of construction, I mean, the faucet's been effectively turned off, for development. And you and I know, Matt, from just experience and tracking this, a lot of times the deliveries don't always match up with what is expected.
Yeah.
It typically gets spread out over a longer period of time because there's construction delays. Some projects end up not getting, started, or they're put on hold, especially when, interest rates have gone from, the mid 3s to 7, 8, 9%, depending on how you're borrowing. Construction loan, you're typically paying a pretty high rate.
Yeah.
And with performance not as good, and rents maybe down a little bit from their projections, a lot of deals aren't penciling. So it does give us a little bit of hope that we may be, closer to the bottom in terms of operational performance, not necessarily in, full price movements. And we may still have a little bit of room to go. Although with the 10-year Treasury coming down kind of the 4.3 range, that kind of opens up a lot of doors for potential acquisitions.
Yeah.
So it's starting to materialize of maybe not like right this second, but 3-6 months, we could be in a really exciting buying opportunity to position for a really strong hold through 2025
Yeah.
and onward, because we should have a lot of really good lift off,
And
especially in 2026.
And, and I'm not sure the specific timing on how quickly rents fall off after new supply enters a market. But according to CoStar, the supply is only going to decrease. The new supply is set to decrease consecutive months and, gradually decrease until basically 2026. But all that being said, I do want to note that it does seem like in this reaction, it kind of counters the narrative that things are going to go bad, or that there's something inherently wrong with multifamily. Like, the problems within multifamily are probably more due to whatever is going to go the way of the economy. If there's a recession, or if there's a big boom time, or if there's inflation or something, multifamily may follow that. But there's nothing inherent in, it's not like they were making huge amounts of mistakes, even though they were building hand over fist in 2021, and they're just getting completed today, and we've just gotten this glut of new supply that's just peaking. We'll see in the apartment list report, our rents are crashing like you maybe would expect if we're in a generational peak of housing supply.
I want to bring up something that you brought up a couple of weeks ago, Matt, and it's this concept of, even with this onslaught of new supply, and even with rents have growing so much in the past, you'd think there'd be some sort of mean reversion and correction, but it's like there has to be, right? But it's so much more mild than it could be, and given the headwinds, still making forward progress, and in terms of rent growth, in many markets, we're not seeing in some other really high supply markets, not even the as deep of rent declines as you might have seen. Again, they're still way positive over a couple of years ago, maybe declined over last year or a year and a half, but still. Really strong. The strong performance, I think, needs to be highlighted, and that I think there's strong housing demand right now, Matt. And we've talked about just housing demand is housing demand. Now, I can be a little bit more on the rent or for sale. In the pandemic early on, when everyone was rushing to buy houses, you might have thought, that's probably not good for apartments. No, housing demand is housing demand. Yeah, apartments filled up to 100% occupancy. Case-Shiller came out, new Case-Shiller numbers year over year, the home price index, year over year, home price in the United States, when we've seen 8% mortgages, they should be down, right? Yeah. They're up. They're up 5%. Yeah. They're up 5%. That's because of, low inventory for sure. But supply and demand is supply and demand. I mean, no one's moving out of their houses if you've got a low interest mortgage right now, unless you absolutely, you have to move or something. But so you're still seeing strong home buying activity, and that's also driving demand for rental activity as well. And so
that's what I was kind of thinking about. These greater contexts, especially housing, is probably the biggest context that will affect apartments specifically.
You've got a lot of household formation going on right now, and again, millennials are they're settling down, and buying a house to settle down and isn't necessarily an option. But there's a lot of people that are looking for space, places to live right now. Again, that's the great thing about housing is it is a necessity. For life. Shelter is something that everybody needs. And one, it never goes away. But we're seeing incredible amount of demand in face of supply. So when we see the supply start to dwindle down, the deliveries. I mean, what do we think is going to happen in the next couple of years?
Yeah. And I remember thinking, and this is another thing, I'm not thinking 3 years, thinking more like 10 to 15 years, maybe even 20 years in the future. We're talking about like maybe population decline, or, I remember reading early in the pandemic, this Cushman and Wakefield report that, but, this market will react to that as well. One thing that is notable about the apartment market, even compared to the single family home market, it is ruled by a little bit more reason, and it is a little bit more stable than single family home. Just look at what happened, after 2008. There was, home prices crashed, but rents really didn't in the same way.
Yeah, they took a little dip for like a year, like a year and a couple of quarters, and then sharply rebounded afterwards. And and there is room to grow. I mean, looking at wages, there's real growth in wages outpacing inflation right now, so that's really positive. And I was having a conversation with our chief investment officer, Jay Reeder, the other day, and we're talking about affordability in terms of it's like people are stretched pretty thin in terms of inflation, and that is true in many ways. But that same situation of rents had already risen so much was the same case in 2019 and 2018. Yeah. I remember having conversations saying, everyone was doing all these value add deals, renovating units, bumping rent, a couple $100. You can only do that so many times. There's just no more room to go. And then, and things weren't affordable in 2019. They weren't. And then all of a sudden the pandemic happened and rents increased 30% or so. So the demand does move pricing, and affordability can shift around because you still need a place to live. Maybe you can't afford the nicest place, but there's still an option because there's a variety of sub asset classes, C, B, A, and all the variety in between. So I think we're setting ourselves up for some really strong demand over the next couple of years, but we're seeing light out at the end of the tunnel. It's looking good. May not be the flash of a hydrogen bomb. Yeah, hopefully, because all of this. So we're talking about operational performance and fundamentals. There is still this cloud over here of these loan maturities that could affect asset valuations. Not only bring the pricing down.
And rent's not doing great in the short term.
Yeah, right now, in a lot of markets, we've had negative rent growth year over year.
This is all short term, though.
It's relatively short term. It's related to supply. And so, again, coming back to this, again, can't time anything well. Just people can't. Yeah. Especially me, people in general. But 3 to 6 months could be a really exciting time. Maybe sooner, maybe later. Could be at the end of next year. But I think as early as, end of Q1, I think we could be potentially in a prime buying opportunity. Now, everyone else now that we're talking about it may see the same thing, and we could see prices start moving right back up and cap rates to compress, especially if we see the long-term maturity interest rates, the 10-year Treasury, continuing to decline. Now, a lot of market watchers are anticipating the 10-year Treasury to kind of stay, at least around 4%. We're in a range between 3.5 to 4.5, which is a pretty big range. And at that level, it's probably not, it hasn't declined enough to allow for neutral refinances for a lot of these borrowers. So, if we're looking back at our, loan maturity reports that we did, first back in June, Matt, and then in September or August when we released the second version of that was in a time period where the 10-year was around 3.5, 3.6, if I recall. It wasn't above 4 at that time. And just looking at interest rates at that level, it didn't seem like refinances would be possible with the current valuations, which valuations are actually even lower today than they were back then. Yeah. So it's going to be moving in the right direction for a lot of borrowers. Is it going to be, and for those on the margins, absolutely it will help. Yeah. But if you're not on the margins, and if you're in one of those markets like in Austin or Phoenix, where you've seen a lot of Atlanta, you've seen a lot of rent declines, it's probably going to be, too late.
Yeah, and we were kind of talking about this beforehand too. It's like we have, as much as the cloudiness has got a near-term cloudiness has seemed kind of more certain, we're also getting a very clear picture of what is going to happen on the other side of it. But that hope on the other side, I mean, those borrowers were already hoping on the other side of it. I don't know if a clear picture or a more hopeful future in 2026 is going to change. They're just running into a wall. Yeah. And if they can get past it or get an extension or get some kind of fix for it, they will, and they would have already. Yeah. So it will be really interesting to see maybe how banks would interpret this.
Yeah, I think if the banks are saying, hey, no, there's hope for lower rates next year, people are calling for even cuts to the Fed funds rate. Yeah. Again, it's that when the 10-year hit 5%, I think that that really sapped a lot of any hope from some banks, lenders, borrowers. But now that we've really moved off of that, and the stock market's been rallying, and we had an attractive CPI print on the last CPI print. Mm-hmm. Yeah, I think it's injected a lot of optimism. Certainly, that's what the narrative has been. Again, we always talk how the narrative shifts about every 3 or 4 weeks. So just get ready, and maybe I think this GDP print could be the beginning of that shift of maybe we see some higher inflation.
Yeah,
and so just again, just to show the headline, the economy is, despite again, it's the same point that we're trying to make on rents. The Federal Reserve has raised interest rates, to 5.25%, 5.5% on the Fed funds rate. In all other circumstances, and 99% making that statistic up of economists, would say that would send the economy absolutely into a recession. Now, we did have 2 quarters of negative GDP growth next year. That doesn't count, apparently. But outside of that, no recession has shown up. Now, could it? 2024 isn't here yet, and again, there's still some black clouds on the horizon. Is it going to be a drizzle? Is it going to be a full-on thunderstorm, tornado? Not all of that is possible, but I think we should be somewhat appreciative of the economy is really working right now. Business is being done.
It definitely does seem more optimistic on the economic front, or at the very least, it could be this situation where, every tick down of the interest rate or every sign that maybe the financing is going to get a little bit easier or softer, every little sign is met by extreme enthusiasm from stock markets and a little bit of an economic bump that might be a little too vigorous, and maybe, I don't know if that means that the interest rates stay higher, or it puts maybe like a floor to as low as or as quick as interest rates could drop before they're it's some more irrational exuberance.
I assume we've got to have just continued volatility in the longer term rates, the 10-year treasury, and that's what makes acquisitions challenging. Continue to be challenging right now, because if you were looking at a deal 2 months ago, and the 10-year was at 4%, and then all of a sudden it ran to 5%. Well, that sunk the deal. Now it's down to 4.3. Well, if you're underwriting a deal when the 10-year was at 5, now it works. You can see how quickly it can move. So, if you put a deal under contract, it's going to be 60 days before you close, but it's taken 60 days to get to that contract point. So you underwrote, from underwrite to close. We talked about this. It could be 6 months. It could be 4 months. It could be it's a long period of time. It's a long time for the 10-year treasury to move around, and everyone's excited that it's moved to the downside over the last couple of weeks. But that's a relatively short-term trend, and could it continue 100%? But it could also move the other way, and moving the other way, it's not a 0% probability. That could mean your whole deal doesn't work anymore.
And that is so from the time that you sign that contract, basically you're not locking
your interest rate.
Not locking your interest rate, and then you have it's like 60 days before the bank says, all right, this is the interest rate.
No. It's usually much shorter than 60 days. 60 days is we've signed the contract, and our due diligence begins, and typically you're not going to really start the full loan process. The lender won't start it until you're under contract, because they're like, hey, if you don't got the deal, we're not going to spend our time on it. And as the buyer, you don't want to start spending all that money and making deposits with the lender until you're under contract. You can start doing some work, but you want to be careful when you spend your money. But then that depending on the now, if it's floating rate, it's a little bit different, because it's more based on SOFR, which can move around, but it's much more much closely tied to the Fed funds rate, so it doesn't move around as much. Now, the spread could change a little bit, and the cost of the rate cap, depending on what were the forward curve.
And
I know we're kind of
I was wondering about that time period. So from when you sign the contract, how long do you wait until what
your rate? So if you're doing fixed rate financing, it can be it's typically a couple weeks before you close.
Okay.
I usually, some lenders, will say we can rate lock really quickly, but they got to go through their process underwriting before they can actually rate lock, and they have to underwrite the sponsor and all.
What if they know it really well?
And that they know the deal? They still because it has to go to a credit committee, and you have to run credit. You have to run reports and review it and take a committee, get sign off, and you're good. And you've got the liquidity, and you're a good borrower. The property's good, and then we'll give at that point you can lock your rate. Typically, there's a deposit that goes along with having to lock your rate. And again, there are different strategies, and sometimes you can lock sooner than later. But bottom line is, and again, we've done multiple deals, last year where the 10-year treasury moved 100 basis points, and we had to renegotiate and retrade.
I remember this kind of stuff.
And that can be risky. Really, it's very risky to a sponsor because you have to make some really tough decisions.
Yeah. I thought that there was one, maybe it was a refinance where we kind of, I don't want to say lucked out, but like we were in a small window of time where when we were refinancing Forest Ridge, we locked the rate the day before the Fed meeting. Yeah. And the rates skyrocketed. If we would have been delayed in locking that rate, which was only about 2 weeks before we closed on the loan. Yeah. If we had been delayed, it would have gone from a cash out refinance. So we actually got money through the refinance, which is super rare. Not never, but very rare these days. But we would have gone from cash out to possibly neutral, possibly even having to put cash in the deal. Wow. Same operational performance. I was 100% occupied, crushing it. Oh, sorry, 10-year move. You're gonna have to pay the bank some money because your new loan isn't enough to cover your old loan. And that was, and again, Forest Ridge was like 100% occupied, crushing every metric that we had. It was outperforming. So if it's a deal that's in a market or just operationally isn't doing well, it's a double whammy of the interest rates have moved, so your loan proceeds are going down, but also the value and your debt service coverage ratio, because you have to have enough money to pay your mortgage, your performance has gone down, so we have to give even smaller loans. So you have to bring even more money into the deal. Yeah, which your operational underperformance is bringing down returns, and now more debt service. And more money into the deal is going to dilute your equity. Maybe I don't know how necessary it is, but to extend this to the greater economy, same with businesses. Yeah, maybe businesses aren't doing well, or their expenses are over, and they have to renegotiate with the bank. I've seen these banks come in, and at my old job, they come in with the suits. They look over your inventory, and it's always probably a fraught discussion over whether they're looking just like they're maybe looking over the deal. They're looking over the way that companies are operating. But again, despite this pressure that's still there, we see GDP growth. We see Black Friday,
and so that's what's really tough is that you have these kind of two divergent paths in risk of like, oh man, you want to get in, take advantage of some of this. Now your existing assets, will, so that's good, but how do you get in? What's your entry point? Do you just roll the dice and say, we're just going to assume the 10 years 5%, and if it goes lower, that's great. But then you also have to have your investors be okay with returns looking really bad. Yeah. And I think that's in terms of capital raising, raising capital universally. Black Friday was a success. It sounds like, which is surprising. But it's just I want to talk about capital raising, and then we'll talk about Black Friday. Everyone you talk to, capital raising is difficult right now. A lot of investors on the sidelines just want to wait and see. There's just a lot of risk, but at the same time, investors are eager to start redeploying capital, but they want it to be in a good deal. So even if a deal that you can draw a pretty probable path of it being decent, you kind of have to discount the current environment. And again, if you're going to assume that the rates are going to be kind of a worst case scenario, and cap rates are going to be the worst case scenario, and rent growth is going to be worst case scenario, the deal is going to look not good. Now you can turn and say, like, if we are on a path that we described earlier in the show, Matt, where we see good rent growth, occupancy has already kind of bottomed out and starts rising again. Buyers come back into the market, interest rates actually go down, cap rates compress, so values go up. Then all of a sudden, and I think that's a likely outcome. And regardless of whether low maturities bring that values down further, it's kind of irrespective of what that continued performance of that investment would be. You might say you maybe overpaid a little bit, but you can paint a picture where it's a really good deal. But an investor rightfully will say, well, there's just a lot of speculation, and it seems like a lot has to go right for this to work out.
And that does seem like the mood
it's a challenge.
in like capital markets in general, and despite
equities, whatever.
what we've seen with the reports from some brokers and others that are trying to put a good spin on 2023, and we covered like it was like a CBRE or a Marcus Amila chat video where they were like, actually some people are just jumping in, and I saw there were BizNow articles
We had one buyer jump in.
Yeah, well, all right. But like there are people jumping in. It would be tough to characterize everyone as like this is a time where they're really finding deals. I think that there was more fervor and search for these like magical opportunities in 2022, and in 2020 around this time in 2022, like, oh man, there's going to be some real great deals to snap up. 2023, after this whole year, people aren't as excited as they used to be, and they're a little bit I don't want to say exhausted, but they're much more realistic about what's possible, and they're not going to be they're not as ready to part with their cash or as optimistic about the short term. Now that creates a good investment opportunity, if you can kind of catch people asleep.
Yeah, and that's why, again, it's the time that it seems like it could be the worst time to invest is often almost usually the best time to invest.
Yeah.
When everyone's like, I'm exhausted, I'm just not buying anymore. Because everyone will figure it out once like things are turning around. Mm-hmm. But there's a period of like confusion and fog of war of kind of right now of like, is it bad, is it good?
Well, even consumers, I mean, not to make that unnecessary, I just want to so I could connect that Black Friday thing.
I was wondering, I was like, this article's here,
consumer sentiment's down, but I
think consumer sentiment has turned around. I saw a report recently. Consumer sentiment has turned around, and if anything, apparently good. Everyone's spending on Black Friday, which again, Matt, we were talking about. I had to go to Lowe's on Friday. I don't, never really done the whole Black Friday thing, but I was driving around. Wasn't that busy.
Yeah.
So I don't know if everyone's just shopping online.
That was the same report from our wife and her family. She said she went downtown and the streets were relatively empty on Black Friday. It's not like they're clamoring, or at least this is the anecdotal information, but stuff's happening, and it is a weird disconnect. As much as the numbers might say it, all the news reporting and all of these man on the street. I listened to a bunch of them over the weekend. These man on the street, everyone's like, well, no, I just don't think things are going well, and like there is this general consensus, at least, that things are doing more poorly than a great 5.2% GDP would indicate.
I think the whole conflict in the Middle East also kind of got people really nervous. Yeah. About a little month and a half ago or so, and now we've seen, I think, some of the sentiment turn around like before kind of this whole ceasefire. But I think that now that things are a little less spicy in the Middle East, there's not like an immediate path to a larger conflict, or maybe just some time's gone by and people are paying attention to other things. I think that added a lot of uncertainty into I think just the general sentiment of people, and I think that's waned a little bit. And then adding in some positive economic news, the stock market. I mean, the stock market has been on a tear. Yeah. So I mean, if that's a forward looking indicator of 6 to 9 months out, we're looking through, relatively, positive lens, calls for, Fed's funds rates even to be low. I mean, I believe Deutsche Bank has a recession call still for 2024, and that's going to bring interest rates down, with other, larger firms not calling for a recession, but, rates falling, then that's going to help, that discount rate to some of those stocks, especially tech stocks, to rally, just as it'll allow real estate to rally, interest rates come down. All these buyers, whether it's single family home or multifamily buyers on the margins, will start to, come back into the market. But the key is, once like all that is happening, it's going to be not necessarily too late, but you're certainly not going to be buying, at the bottom. And again, you can't time anything well. And so if you want to be buying at the best prices, you're going to have to start buying maybe before that bottom. Yeah. And the risk is always, obviously, you don't want to catch a falling knife. But if, I heard, the way described recently as like, you want to be, if like the market peak is 12 o'clock and the bottom 6 o'clock, buying between kind of, 5 and 7 isn't a bad idea. And maybe even kind of 4 and 8 isn't a bad idea. either, because you're still going to be able to ride the upswing up back to 12, and if you sell at 11, that's okay. Or even 10.
Very good point.
So it's going to involve, and it's going to be a challenge for us. We look at, we're looking at an opportunity right now, and big $30-40 million of capital to raise.
Mm-hmm.
It's an incredible growing submarket. It needs a little bit of work. It's relatively brand new property though, but there's not like a ton of interest for $30-40 million for common equity right now. If they're, let us know if you're like, I want to jump in on the deal, because again, it comes back to, I can model out it being crushing it.
Mm-hmm.
But if I, kind of take our normal tack of, let's kind of discount the whole economy right now, and not worst case scenario, but like, really reducing our speculation, it doesn't look that great.
Yeah.
But the market momentum, the organic growth, as well as some, the renovations, I think could make a lot of sense. But can you convince $30-40 million of investors to think like we do?
Yeah.
I think we could, but it's a big question.
Well, and that was part of what I was looking at this week as I was gathering the sources and the research and stuff, is sales volumes for multifamily are significantly down. And in Q4, the big question that I'm wondering is, Q4 going to see a lot of like last minute deals. It's such that it's going to be actually higher sales volumes in Q3. That is a big open question, because last year in 2022, I think the Q4 volume was higher than Q1, 2, and 3.
It often is, just because deals rush in to close before the end of the year.
Mm-hmm.
And people have end of the year deadlines.
Right now, CoStar has the projections for Q4 at about half of what Q3 was.
Interesting.
Now, I don't know. That's their current numbers, and we're about like a little more than halfway through.
Sometimes I wonder on CoStar, sometimes their algorithms on the forecasting, like they follow that trend, and which, like, sometimes that is fine, but like they take out the, like, oh, it's the end of the year, so you actually see a little blip, seasonally. I don't know. So I want to talk again, because on this topic of time to buy or not buy, looking at again, storm clouds kind of forming over, or they've been hanging out here. We've got loan maturities, we've got all this debt that's out there. Federal government, multifamily business, everybody. But then RealPage, they have a compelling piece by Jay Parsons. The census is likely overstating multifamily starts in 2023, which means that we may not see vacancies levels as bad as we might have thought, and could potentially be seeing kind of a bottoming out of the slowdown, not deterioration, but the slowdown in multifamily fundamentals. Matt, you did a really nice write-up. What's your take on the Jay Parsons
we've been
piece?
tracking the reduction in multifamily starts on the Gray Report, alongside like a bunch of, a lot of these multifamily experts and reports have, we've just described why. Interest rates are high. There's not a lot of projects going on. But this analysis here from the much admired by Gray Report, Jay Parsons, I think it really cranks up this possibility even more that starts are lower than we have and others have anticipated in 2023. And we already thought they'd be lower. They're even worse, lower. High, and the reason why is not a mystery to anyone. It is higher interest rates. It's made so many of the multifamily development projects that once made financial sense, they're not profitable anymore. It's not like all of them aren't profitable, but maybe out of X, Y, and Z, maybe only Y or Z.
No, it's hard. Yeah, talking to most developers, it's hard to pencil right now.
Yeah,
with leverage financing. And rent's not as high as they thought they might be.
Yeah, that's a good point. It's like their projections, and getting back to like what I said about the reactive nature of these developers, like they're making such a big bet, and they're not gonna if they're not gonna ignore rent growth or ignore supply trends or whatever. They're trying to get ahead of it as much as they can. So again, this is not a runaway train, and this article proves it out in that the census says that apartment builders have started 12% less projects than last year, but Jay Parsons argues that it's likely closer to 40% less. And he writes that it appears the census underestimated multifamily starts in 2022 and overstated them in 23. It is an issue of higher interest rates, but also loan to cost ratios dropping from 65 to around 50 to 55%. So they've got to get more money. And this tightening standards is bringing about not like even canceling the projects, but just delays. And the problems with delays, Jay Parsons says, is like they can be indefinite. You can delay it forever, and so that it makes it difficult. But it also is. It's difficult for the developer side, but it's also an example of like, yeah, they're reacting. These projects, once they get started, sometimes they don't get finished. And we have talked about like the attrition rate from going from permits to actual starts to completions. There's a lot of hurdles that have to happen, and things could not get finished in that time.
And like not finishing doesn't necessarily doesn't typically materialize in like the building's halfway built.
Yeah,
it's usually like
true.
The land's ready to go. Maybe the permitting is in place, but they're not pulling the trigger on doing the actually starting moving dirt.
And I thought it was really interesting. It was the cause of these delays. It said something like 90% of some of these delays are in some way connected to financing, either financing or getting funding or just getting the money.
Hard to raise capital. The leverage isn't there, and the leverage isn't there. The returns aren't there, and you can't raise the capital, and it's a vicious cycle.
Because another way for labor and commodity shortage is just higher labor prices, higher commodity prices, so you can pay for things to go quicker.
Yeah.
But if you don't have that money, then there's going to be delays.
Exactly.
But widening the lens a little bit, Jay Parsons says that construction volumes, and I mentioned this, and I still think this is a really powerful statement here. He says construction volumes from 2021 to 2022 could very likely go down as a generational high akin to the 1970s, resulting from a perfect storm of ultra-high demand and rent growth, plus an environment of cheap debt and low cap rates that incentivized ground-up development. It really was this, call it perfect storm or just like the an investment miracle. Did he call it? Because it wasn't a storm necessarily. It was just this ideal situation. It was favorable winds, let's say.
There we go.
But it's not to be understated how much building there was. And, comparing it to the 1970s, if you take any look at these long-term trends, like 1970s was a blowout year for apartment. That was like when they were building all the places for the boomers to live in. So this is notable and very likely something that we won't see ever again in our lifetimes.
This type of construction.
Yeah. So, we're in the wake of so many of these different generational high points and low points in the apartment market, whether it's rent growth, financing, cap rate spreads, or apartment supply.
It underlines, so what you're saying is like we're basically experiencing a supply shock. Maybe not as bad as what was first anticipated in forecasts, but as strong of a supply shock really the market has ever seen and more likely will ever see. And absorption is still like decently strong. Now supply is outpacing absorption. Vacancies are higher, but it's not, it's not like everything is horrible. A lot of things are maintaining, rent levels, again, increased so much over the last couple of years. Again, back to your point, it could be so much worse. And the fact that it's not that much worse underlines the strength, and you remove some of the headwinds. You're just going to be off to the, you're just going to be smooth sailing.
So it's a testament to
relative smooth sailing. I don't qualify that. Never smooth sailing in this business.
But it is a testament to the stability of the apartment market. Full stop. And any discussion, and we'll get to a little bit of the. We'll quickly cover the apartment list rent growth report, but you have to put that into context that we're seeing some of these kind of historical movements right now. Yeah.
Well, let's just jump right over to that apartment list report, Matt. Looks like United States, the median rent 2017 to present, a couple oscillations moving sort of to the downside. It'll be interesting. I mean, typically in the fourth quarter, we see the most declines just seasonally. In your opinion, Matt, this winter, specifically December, the month that we are going to begin in 2 days. So as folks are watching this video, listening to this podcast, are we entering the bottom of rent declines? Yes.
I think so, and it's more instructive here. So yes, the top line number is about negative 1% year over year. Whether you're talking about nationwide median, which is below 0.9 or whatever they said as year over year rent growth is at negative 1.1%. But
and 1.1 is like, again, back in the pandemic, or back in the Great Financial Crisis, I think it was closer to negative 3. I mean, negative 1 when we had 30% growth over the last total over the last couple of years is not that. I mean, again, come on, that's not a whole lot of it. That's a mean reversion.
I mean, look at this chart though. Exactly. Like if you draw a straight line from you're still not really making. If you draw a straight line from 2017, to 2019,
tools
and extend that into 2023, you're still not where we are.
Yeah.
It jumped up so much in 2020 that you would expect a slightly stronger adjustment, a slightly stronger drop, I guess, but because we're in the wake of this super high rent growth. But to kind of double down on my point here, it does look like we are approaching a little bit more of stability. If you look at the month over month chart that they have, a little bit below this line graph, there is a series of bar graphs that show, a bar graph that shows how rents have changed every single month. And in 2022, the monthly dip in rent growth in November was more than 1%, and it's slightly less this time. It does seem like, as we said before, that this winter is gonna have the same rent growth pattern as 2022, but weaker on the in the downside than 2022. So yes, we will see a dip. It won't be as dramatic or sad for apartment investors as 2022 was, and I think it is a sign of greater stability and an adjustment to, I think, steadily declining numbers of new supply in apartments. But it's going to be a long time coming. But this is a clear sign, like this, things aren't getting worse, but we just have to we've got to stay strong.
yeah and that's important. It's important to remember that in the face of some of the, I think the financial hurdles that a lot of these properties face, again, the way that they were financed with, like interest rate cap escrows going up, or having to purchase a new interest rate cap to kind of hedge against, rates rising. The property could be a great performer. Yeah. Fundamentals are really solid, but it was financed a certain way, and it doesn't seem like the property is performing that well because so much money has had to be escrowed for future rate caps, or just your interest rate has risen, or whatever the case may be. And so I think there's a disconnect right now between kind of operators, investors, and kind of just the reality on the ground of, to operators, I think it's looking a lot worse than maybe it actually is. And again, if you're an operator and you're thinking about capital calls and you're thinking about not being able to refinance, like, okay, great, this is good news that maybe rents are bottoming, but like that's not my issue. My issue
one of many issues.
Yeah, it's like, oh yeah, that's on the list. Like it's not a bad thing, but my issue is the forward curve and the way that my rate cap provider has repriced my escrows. I'm having to send tons of money over there, and so I think there's a disconnect that's going to be, it's going to be those who will find success are going to be the ones who can kind of see through the disconnect and find the opportunities and not be too bogged down on last year's deals. I mean, Matt, we're looking at using bridge loans again, and we made a hard roll, a little over a year ago, no new bridge loans, no floating rate debt. But we're entering into a new period, and have to be flexible. And I think there's an opportunity to use some bridge debt products. When we've been using fixed rate over the last 18 months or so for good reason, to avoid any interest rate volatility. But I think there's going to be some more tactical strategies to really take advantage of the current environment.
I think that makes a lot of sense. People say higher for longer, and I think you've even said too, it's like, well, maybe it's high for longer. I don't think there are any predictions of interest rates going up.
Way up. Yeah.
Maybe the 10-year might.
I mean, the economy's doing good. The economy's doing good, but it sounds like we're still working our way out of the pandemic and COVID and some of all those shocks and the stimulus, and the economy is still,
the question
chugging
is,
along.
is it stay at the point or tick a little lower?
Yeah.
It looks very. I haven't heard anyone predict. This is my expert opinion.
Yeah.
I haven't heard anyone predict that it's going higher. And it may just be
the only predictions of higher are that it goes back up to 5. 10-year goes up to 5.
Yeah.
On terms of interest.
Yeah,
rate.
the 10 rate. Yeah,
and but inflation. We could be surprised, but most likely, it's not. The evidence isn't pointing at. New data could come out. But right now,
very true.
It doesn't look like we're seeing runaway inflation. Everything is relatively in line, and this idea of soft landing is a real possibility.
Yeah.
Matt, where would you like to move to next?
Let's talk about this Axios short brief report from Axios on home vacancies. So the headline here is that home vacancies are near all-time low as housing shortage bites. As befit, exactly. It takes a it's chomping at it. It really demand is chomping at the bit. But as befits Axios's typical style in the mission statement, I'm going to deliver this with their trademark brevity. So just hit the bullet points here real quick. Housing vacancy is down to 0.8%, which is close to the lowest number on record and reflects the extreme tightness of the housing market amid a historic housing shortage. New single-family home starts ticked up for the second straight month, which could bring some relief, but the housing shortage is not going away anytime soon. I tried to have a little newscaster voice there at the end. So this is a good news, I guess, for housing investors, for maybe for home values. I mean, I think so. And for apartment investors and anyone that's kind of involved in the housing market in general in that way. But I would like to really extend the data beyond this brief write-up. And it's not necessarily the home or housing vacancy that's at record levels. This number that they are using is for single-family home vacancies. So 0.8% vacancy is not what we were seeing in the apartment market, which is close to 6.
No, it's not. But again, it underlines the fact that people are looking for a little bit more space. There's household formation and there's the overall demand for real estate, and they're like, again, to further make sense, I can't buy a home because I can't afford the down payment or whatever the case may be. It's unaffordable. I don't qualify, but I still want to live at a house.
Yeah, the general point is totally the same.
There are very few houses available to live in.
Do we have a chart up right now?
We did. But we'll put
it is crazy to look at this chart and see how, and they've got these numbers back to 1960. We've never had a single family home vacancy ever this low. It's kind of crazy to think about. Like, we're not, it's not necessarily like it's such a big part of life, but it's not like a defining part of life like it was in 2008 when people were thinking about the housing crisis.
Yeah.
But this housing shortage crisis, I think arguably could be talked about a whole lot more.
Yeah. Again, I think this is all put in the backdrop of, the entry point into real estate right now is fraught with challenges.
Yeah.
But I think it's shaping up to be really exciting and a really good opportunity to get in over this next year, to take advantage of the growth over the next decade or so, or really this next real estate cycle. The real estate cycles are long. They go through periods of disruption and shake up, or potentially crash.
Yeah.
And we're certainly going through a little bit of a shakeup right now. But again, the next, whether it's 5, 10, 15 years, we're setting ourselves up in the right way. And, you don't want to be too eager to pull the trigger.
Yeah.
It's got to be a good deal. You can't just say, I'm going in, I'm just going to buy real estate and wherever it is, whatever it is, at whatever price. Yeah. Time for prudence and due diligence and creative thinking has never been more required than it is today. But there's going to be a lot of people that miss out on the opportunity because they're going to be sitting on their hands when the best deals are going to present themselves.
Yeah.
I still think preferred equity is a great spot to be in right now, kind of in the meantime. We're still going to keep doing those deals. But I'm excited. 3 to 6 months, I think we're going to find a good deal.
For sure. And even just to put this, so the rental housing vacancy is currently at 6.6, but that vacancy itself is much, much lower than it was really at like any point from 2013 back to 1985. So like, there is this housing shortage for rental homes
we're
too.
seeing in our portfolio, it's an anecdote, but I mean, we're seeing occupancy. Well, we're 100% at a couple properties. There's a couple markets where we're seeing a lot of supply that are, sub 90%, which isn't good. But for the most part, we're kind of 95, 93 to 96.
Yeah.
And that's kind of typically where we have always been historically. The Indianapolis specifically is typically like 93% occupancy. Like that's typically what, that's like the long-term multi-decade average. We moved to hit 90, maybe 95, and during COVID, 96%. It got tighter. Now we're down to 93, 94. That's okay, but it's kind of normal.
Yeah.
And again, in the face of all the supply and the headwinds and the uncertainty, it's pretty impressive.
Yeah. There's a lot of balancing that's going on right now. It seems like, despite a lot of ups and downs and volatility, it is worth noting how stable the multifamily market has been, and to kind of put it in the context, like we could have been in for a roller coaster. If it was a stock market, it would be pulling our hairs out.
And I'm not holding my breath though. I mean, and again, we've got all these borrowers that there's not to be optimistic, so it gets like you can forget about all of that.
Yeah. But
again, I see this that dark cloud that's like has not gone away. That it's worth watching.
Yep.
But if anything, that will usher in the type of price discovery of deals needing to transact. That will allow us to again to figure out what prices need to be, where the market is, and if there's more stability. I think this market can really start taking off all of a sudden because I think the deals are going to be too good to pass up for a lot of buyers.
Well, yeah,
they're seeing these fundamentals.
And just to kind of segue as a kind of barometer of the market, this Collier's capital market, we've seen a lot of these capital markets reports and stuff, and so it's like nothing new, but it is another reminder, and I like some of the information that they had here on the progression of the really slowdown in investment in 2023. 50% lower investments in CRE compared to last year. Really paring it down. It pares it down with some specific dollar values for quarterly investment volume for the different sectors like multifamily, office, industrial, retail, and hospitality. But the overall context is like the end of Q3 marked 4 consecutive quarters with over 50% lower investment volume compared to the year before. In other words, starting from Q4 of last year, every single quarter had less than half the amount of investments in that same quarter the previous year. Now, part of that 50% reduction in investment volume is a reasonable adjustment after 2022 and Q2 and Q3 and the kind of hot market there, but it does not explain the entirety of that reduction. We're still falling off from below. It's not like if you take 22 and balance it with 23 and if you take all those years and balance them, we're still below right now. People aren't interested in investing in interest rates and these other, it's a little bit slower growth in some of these sectors.
Sentiment is slow to shift.
Yeah.
Like we were just talking about.
Yeah. So it's going to take a little while to come up. And I do agree, like that's maybe where the opportunities are. Multifamily specifically is $30 billion in investments in Q3 and year-over-year price changes 12.8. And they are forecasting further price reductions for multifamily. Either way, it says, like whether, no matter how things shake out in the near term or in the long term, it says that near-term supply side pressure will cause some markets to soften as concessions escalate and asking rents begin to fall. They're not making specific calls, but they're saying it's going to be a bumpy ride a little bit. The CoStar multifamily numbers also show roughly the same story of reduced property sales volumes in 2023. Yeah. So that's multifamily specifically. It's pretty much the same for all these different sectors, except for industrial. It had a very small 0.8 price reduction, and investment volume was down 21 billion. Retail price reduction was down 6.9%, but it had a little bit more investment. Finally, hospitality prices were down 0.1%. So of all of these categories, office, industrial, retail, the one that took the biggest beating in terms of price reduction was multifamily.
Well, and multifamily, was one of the highest appreciating the asset classes. Now, I'd say industrial, also appreciated a lot, and it's been a little bit more stable right now.
Yeah.
But, retail, hospitality, especially office obviously didn't grow nearly as much as multifamily over the last couple of years. So there's more room to come down. But I think they all have a slightly different story. But again, there's so much over enthusiasm in multifamily in 2021 that I think is really kind of the cause of that, of just coming off the fever.
And I think that we're going to keep some of that enthusiasm. Like some of that,
people are still very enthused.
Yeah. And they talk about it here in terms of the balance between CRE sectors. Multifamily used to be, it wasn't the top dog always. And now it is.
No. Yeah. It was kind of like, office and retail and sort of in industrial, that those were like if serious commercial real estate, and apartments were like kind of this dirty other thing that like people did and you could do, but it was a little bit different.
Yeah, but it is caught on in a way that like I think that it will be persistent. And I think the numbers.
No, it's turned into a kind of a cornerstone to a lot of investors of their portfolio, of people knowing that they need to get invested in real estate, and they really like apartments because it's like they're like I'm not going to manage a house or a duplex.
Yeah.
The fundamentals make a lot of sense. There's tax benefits. There's cash flow. It adds a lot of balance to my portfolio. In terms of like portfolio, the reason why more RIAs, wealth advisors, family offices, big institutional groups have a big chunk of real estate is the de-risking and diversification that it provides in a portfolio when you're looking at portfolio construction and kind of portfolio construction strategy and looking at Sharpe ratios. Real estate, really smooths out a portfolio and can be a really fundamental piece of that. A lot of family offices I see, they're anywhere between kind of 15 and 40% real estate.
That's
and so in that there's and a lot of that is multifamily.
Yeah.
Like a lot of that is multifamily. And so that has been a big shift over the last 10 or 15 years where, it's much more classic 60-40 portfolio, and you really had to kind of be in the real estate business. Maybe you owned a couple of REITs, but, people didn't have, a bunch of holdings of other real estate, or they weren't investing as LPs, in other people's deals. And wealth advisors and RIAs weren't offering those types of alternative investments. But now, if you're a wealth manager or RIA, if you're not offering private alternatives outside of the stock market and bonds, you're really missing out on having a competitive advantage. Seeing the growth in the firms that have leaned into real estate.
Yeah, I wonder how much of the kind of changing perception of apartment of the apartment investment is due to maybe more standardized, more efficient property management relative to like office or industrial. There's a lot less.
I think it's probably related. I mean, the industry is seeing a shift moving away from kind of the more traditional mom and pops to there are more institutional entrants. There are also more, private equity, has also played a big role. And when I say private equity, I include, kind of syndications. So I would say everything from less sophisticated private equity, some of it just came out of a real estate boot camp. There's all problems with that, to very large private equity like Blackstone. Other problems, in that category also, or not problems, but, quirks. It's a different type of ownership, and, where the guys coming out of the boot camp, doing their first syndication, pulling resources, they're going to be using a third-party manager, hopefully a larger one, which can have a mixed results, but it's typically, you should be relatively institutionalized management. Can really not work out because they may not be doing good asset management, and a lot of property managers are actually really bad. In a lot of these big institutional groups, there has been a consolidation of some, large property management firms that do a much better job. But, we're seeing less and less of the mom and pop, literally, the husband is fixing the light bulb and the wife's in the office. There are some of those that are still around, but it's, it's fewer and fewer and fewer. So I would say that you'd get mixed opinions on the effect of that. I think it is.
Yeah, there's always a way to ignore. Yeah, you can always like try to like run on a shoestring budget or not address the needs of your renters.
Well, exactly. So the downsides of it's the absentee ownership. You've got somebody managing, but no one really cares, and the people who are managing don't have the authority to do anything. They're not qualified, or they don't have the training, et cetera, et cetera. But conversely, you also can provide much more professional services, or you should be able to provide more professional services and better management.
That's what I was,
and better systems and better offerings.
Well, and that's what I was kind of thinking. And this is just like the thing that flashed in my mind.
But they're making more money at the bottom end. I mean, regardless of what the perception to residents, profits are up.
And well, and
good or bad.
From the perspective of an investor that's looking at like maybe like this a little bit more complicated property management of apartment versus office, at least we have kind of the technology and ways to track how property management is doing. Versus before, it may not have been. Maybe.
The market, and this is where. I think I have comments on the whole economy of where inflation is going to go and interest rates, and I think it could be decently high for a while, but I think over the long term we're going to move down lower, not to zero right away, but I think we're going to move lower because I think the economy in general has become more efficient. Does a little bit of deglobalization, which I think is a shorter term trend, does that affect that a little bit? Perhaps. I think there's too many advantage of kind of global trade to ignore, and markets usually break through that, even if regulators try to, politicians try to get in the way, of trade, usually finds a way. But, the the world economy and finance has become more efficient. And typically kind of prices can go down with efficiency. Discount rates can go down with efficiency. And I also think multifamily has become more efficient as well for everything you said, more sophisticated buyers, more sophisticated ways of analyzing current operations through property management systems, business intelligence systems, artificial intelligence, but also, raising capital and the types of buyers and the way that we're underwriting and analyzing these deals, because it went from, in the 60s and 70s, literally doing it on like a napkin or, it's all, being done by hand. They're not running Excel and spreadsheets. It's all, going off around numbers and, it seems good. I think this is a good price. Can we do it? Let's knock it out and let's do it.
Yeah.
But the cap rate, and that's because you needed the cap rates were high because the margin for error was so high because we were like, oh, we thought that this, but we couldn't do, complicated I'm sure there's some really smart people at math that were doing some decent forecasting, but the most complicated modeling that you were doing probably back in the 60s is probably the most rudimentary that you're going to see today. Yeah. And so it's like you needed to buy at a 10 cap because, you'd often make a miss and you needed the headroom. But that's just not going to be the case today. We have all this data and intelligence. Not that you can't, over rely on some of that, but it's a different world.
Even
more
a small
efficient
scale of like, I noticed that this repair guy or this maintenance guy isn't showing up, as quick. He's not fixing what he said he was going to fix yesterday. Yeah. From the very small scale of like, well, that's not even, it's not like cheaping out or not cheaping out. That's just like, I have this information, I can fix it for free.
Yeah. And we're going to see, real estate is always very like lagging in terms of technology adoption. Yeah. Generation behind, multifamily especially, but I think we're going to see that continue to trickle in AI. We're probably a good 5-10 years to see it fully trickle into multifamily.
One article that I wanted to talk about was this company that we'll talk about next week. But AI and real estate. That's a good teaser. Yeah,
AI and real estate. All right, everyone. Thanks for watching this episode of The Gray Report. Make sure you're still listening, watching, give us a like, subscribe to the Gray Capital YouTube channel. Also check out The Complex, the other podcast from Gray Capital, focus more on operations, property management. If you like the conversation about property management, you want to jump right into that. Hope everyone had a nice Thanksgiving weekend, good break, get into the holiday season, cold weather. So stay frosty out there. Everyone will be. Let's make some good decisions. Thanks for watching. See you next time.